Welcome to my YouTube channel, Invest with Treasury. In this channel, I share smart investment ideas using investment tools and platforms like the stock market, real estate, mutual funds, treasury bills, bonds, ETFs, and others. So today, I want to share with you the kind of risk that you are going to be facing as an investor, be it in the stock market, in real estate, and what have you. So this risk have been neglected by lots of people out there, and that is why many people are not actually prepared for their investment journey. Hence, the lots of frustrations out there, of people losing their monies, hating investing, and not even want to try anymore because they are not done with the memories of their capitals that they lost in investment. So today, as I said, I want to share with you the type of risk that you are going to be facing as an investor, especially in the stock market. So number one is market risk. Yes, market risk. Market risk has to do with those risks that are beyond your control. You cannot control them. I'm talking about like unemployment rate, inflationary rate, high interest rate, and whole lots of them. Something that has to do with regulations in that particular country or in that particular firm or in that particular sector. Like of recent, there was this kind of regulations from CBN concerning banks, and before you know it, there was a big hit in bank stocks. I think somewhere in 2025 there was against 2026 there was a big hit. People started selling off their stocks. There were lots of stocks went down, and people were not willing to actually hold on to their bank stocks before some banks now started making some kind of statement trying to instill confidence in the minds of investors that later brought about people coming back to investing in bank stocks. So that is included in market risk. Those risks that are macroeconomic in nature, in a nation, like I mentioned before, inflation, the general price level in the country, then unemployment rates and interest rates and so on. Then that will take us to the number two. The next risk that you are going to be facing as an investor in stock market is company risk. Yes, company risk. You have to, this risk has to do with those kind of decisions or actions that come from management of a company that you're interested in investing your monies into. Like I think somewhere last year, there was this company, I'm not going to call their names, but I don't want to use this particular company to explain what I mean by company risk. There was this company that published their results, and according to what the investigators found out, there was so much lies, so much misrepresentations of facts in that company's financial statements. So that lured lots of investors to invest their hard-earned money into that particular company. Of course, it happens most times. That is why I'm always stressing that you need to dig deep. Or if you don't know how to dig deep, you need to follow someone reliable that knows their way around in the stock market. At least learn what they are buying, or you focus on companies that are stable. We have big companies that are stable. In America, I think we have 500, S&Ps that are stable. Those companies have come to be. And also, if you cannot do that, you can look at ETFs. ETFs is like a basket. Instead of buying, for instance, let's liken stocks to become like fruits. Let's assume that you have a basket. You went to the fruit market and you decided to buy only mangoes. So that is a stock. But when you now decide to put in that your basket, you decide to combine mangoes, soursop, avocado, pears, cherries, and all those things in one basket. That is ETFs. So the implication is that when one company is down, there is no way the other ones will be down. At least one or two will still be up to balance up your portfolio. Your portfolio is the combination of all the stocks that you have invested your monies into. That is portfolio. So that is it. So it will shield your portfolio from some of the risk that comes with investing. So this company that I was talking about, they falsified their financial statement, giving investors the wrong information that brought about people committing their funds, committing their monies. And then when this thing was exposed, of course, there were uproar, so much emotional uproar that this stock plummeted. It affected this stock that they even went to court and they are trying to, determine whether the person, the investigator was right or the company was right. So these are some of the kind of company risk that you can find yourself in, especially when you're investing in a particular stock. There are lots of them. Maybe the company being accused of fraud, somebody taking a litigation against that particular company, or somebody wanting to, wanting to, take advantage of the company, or even the management misusing the resources of the company. So all these things have one effect or the other against your investments, in that particular company. So that is why we say it's one of the risks that you are going to face as an investor. So being company risk. And that will take us to the next one, liquidity risk. Yes, liquidity. I don't know whether you have noticed that sometimes you want to sell a particular stock and you discover that at that particular moment nobody is buying the stock, because sometimes some of these companies, they are not they don't have enough liquidity, to exchange their stocks for money. So, and the thing will now make you to hold the stock for a longer time. So that is why if you want to invest in stock, is one of the investigations you need to make. This company, what is the demand and supply rate? Are people actually, buying these particular stocks, and what is their liquidity rate? So if you find answers to all these things and then you decide, because the answers are positive, you decide to invest your money into that particular company, that means you must have in one way or the other avoided the liquidity risk that comes with investing in some companies. And finally, emotional risk. This has to do with you, the investor. You need to be someone that is emotionally stable, not someone that is busy being swayed by hypes all over the place, be it social media hypes or what have you. So you need to be emotionally stable, be very, very consistent, know what you are buying. For me, I actually, encourage people to maintain a consistent approach. Consistent approach. I'm not even interested. Like when I'm looking at someone who is an investor, I'm not looking at the kind of money that you have in your disposal at that particular point in time. What I'm looking at is how you have built your capacity to be consistent. I'm looking at consistency. Someone that is not consistent is a no-no for me. I'm very much interested in consistency. So that is why you must have this emotional, stability for you to avoid emotional risk. Because most people today, you hear that this stock is doing well, they will now go and sell this other one in order to invest in this one, and then tomorrow the one that they sold previously is now the one that is the talk of the town. So they are just busy, moving from one place to another, and it's not good for an investor. So these are the these are the four risks that you must avoid. These are the four risks you are going to encounter as an investor, especially if you're investing in the stock market. Let me recap. We have market risk, then we have company risk, then we have liquid risk or liquidity risk. Finally, we have emotional risk. Please don't forget to subscribe, like, and comment. And also share this video so that others can see it, especially for beginner investors. I will see you in the next video. Bye for now.